Buy stocks, make money. What else is there to know? There are many misconceptions about investing that many beginner investors have. And in this video, I'm going to clarify some of the major misconceptions out there and to reveal the truth for you all. I'm Sean. I'm a computer scientist working in AI with a passion for investing. And this is actually the first video of an investing series that I'm going to go through and explain investing and make it as simple as possible. I'm going to explain and show how you can invest step by step. But before we begin, we have to first define what investing is. Investing is purchasing something in hopes that it will increase in value over time. This results in you gaining profit from that purchase. The first major misconception out there about investing is that investing is complicated. I certainly thought this at the beginning as well, and this is something that deters people from starting their investing journey. There's tons of jargon out there, lots of terminologies that people throw around, and sometimes it feels like people in this field use all of these complicated words so that they can flex on them noobs. I know it's extremely complicated at the beginning, but have faith in yourself. I believe you can pick it up, and subscribe to my channel if you want to learn more about investing made easy. There's a common misconception out there that investing is stock picking, and you have to pick the exact stock to succeed. A stock is a share of a company, and if you buy that stock, then you become a partial owner of a company. While you can certainly invest by buying a stock, hoping that it will increase in value and then sell that stock for profits, this is not the only way to invest. In fact, I'd argue that it's not how the majority of investors should invest. Instead of spending a lot of your time researching on specific companies you may want to invest in, spoiler alert, even full-time analysts struggle to pick winning stocks. It is much more advantageous for you to purchase an index fund. All right, first big investing word here. An index fund is a portfolio that tracks a market index. For example, a US total stock market index fund tracks the entire US market. So if the US market grows, then that index fund grows in value as well. Another word that you may have heard being thrown around is the S&P 500, which stands for the Standard & Poor 500. So this index actually tracks the top 500 US companies. And so if those 500 companies do well, then that index fund does well. Investing in an index fund means you're investing in all of the companies that index fund is tracking. So it eliminates the time you need to research all of these individual companies. And with that time, you can party or just go live your life. Another misconception is that investing is gambling your money away and that the stock market is just too volatile. Markets can definitely swing up and down pretty drastically over the short term. But over the long term, we're golden. Since inception, the stock market has averaged an annual return of just over 10%. So investing in an index fund that tracks the entire stock market will likely result in great returns over the long run. The catch is that the market will fluctuate during those times that it's growing. So it's up to you to continually put money in and just let it ride out. Another misconception is that stocks are the only thing you can invest in. It's not. There are stocks, but we just talked about index funds. There are also bonds and bond market index funds, gold, real estate. There's a lot to cover, and we're gonna definitely talk about all of those options later down the road in this investing series. Investing involves frequent trading. There are people that trade every single day, but these people aren't considered investors. They're called day traders. They attempt to buy stocks low and sell them at a higher price and therefore gaining profit. But they spend a lot of time actively trading these stocks every single day. Where investors, it is advantageous for you to buy low and sell high, but we have a much longer time horizon, where time horizon is just your plan on when you need that money. So it could be retirement decades down the road. And so because we are investing for a long time, we don't care about those fluctuations because generally over time, we are gonna see our money grow. Investors have a buy and hold principle where they purchase something and then keep it for years down the road. In other words, trading involves timing the market twice actually, when you buy a stock and then when you sell a stock. And investing involves buying something and holding it so that it grows in value over time. Investing is how you passively accumulate wealth over the long run. Investing can massively help you accumulate wealth, and with that wealth allows you to take opportunities you otherwise couldn't. You could retire early, switch careers, pursue your passions, spend time with your loved ones, being a stay-at-home parent. It really goes on and on and on with that financial safety net that you have with all of your wealth. Pop the like button and subscribe so you can learn how to invest for freedom forever. I'll see you all in the comment section below. Peace.